Recording this seminar. So welcome everybody today. We are talking about our debt management. Is it ever too late to address? We at Momentum personally have been looking forward to this one for quite some time, and we are very, very excited. Before I get started though, I did want to say that in the spirit of reconciliation, we acknowledge that we live, work, and play on the traditional territories of the Blackfoot Confederacy, the Siksika, Kainai, and Piikani nations, the Tsuut'ina Nation, and the Stoney Nakoda Nation, as well as the Métis Nation Region 3, as well as with all the other people who make their homes here in Treaty 7, the region of Southern Alberta. And I also wanted to just acknowledge myself, the tragedy in the United States and what is happening around the racism and the terribleness. And I'm just hoping that we can unite together and love one another and just be kind to everyone around us. I think Nenshi says, what does he say? Kind hands, kind heart, and smile, or something like that. But I really hope that we can continue to do that each day. So I'm going to go ahead and talk a little bit about Momentum. So here at Momentum, we work with people that live on low income, right? And we partner with many people in our community to create a thriving local economy for all. We do this in lots of different ways. Just like everybody else right now, we are adapting our in-person programs. So while they aren't all functioning at in-person capacity right now, we do have a couple of helplines that are running for people to access should they need some assistance. The first one, of course, is our money management helpline. Through this helpline, you can get money management assistance, you can get government and community resource navigation, or even some financial coaching if you need any assistance. The phone number is there, as well as the email address, moneymanagement@momentum.org. We also have the business helpline and coaching, where you can get professional coaches, recommendations for any of your business questions, or even some resource navigation with all the new business tools that have come out. The phone number is there, as well as the email, business@momentum.org. And finally, we have our employment helpline and coaching. And for this one, you can access assistance with resume writing, cover letter support, interview preparation. There's lots of support, as well as some financial coaching available there. The phone number and the email, employmentcoaching@momentum.org, are at the bottom. All three helplines are open Monday to Friday from 9 to 5. If you missed any of the emails or any of the phone numbers, please feel free to visit momentum.org for any further information. Before I get started, I did just want to mention, if you have any questions or any comments that you want to make, please use the question and answer feature. So that'll be at the bar, probably at the bottom of your screen. If you use the chat feature, it tends to get lost in the chat and we aren't able to sometimes find the questions. So if you have any questions, please put them in the question and answer, and then they will be answered at the end. I'm going to hand it over to Nicole Olson now from BNA Debt Solutions. Nicole, thank you so much for coming and talking with us today. We are so excited to hear more about your topic.
Thanks, Jody. I mean, it's awesome to be here with you again. And I really love partnering with Momentum. The work that you guys do here at Momentum is fantastic. I'm so glad that you guys are in the community to try to help out with our citizens. So that's fantastic. I'm glad to talk a little bit about debt management options. And especially during these difficult times during COVID, it's really important to kind of know what your options are, what the options of the creditors are, and how you can kind of try to rebuild yourself throughout this entire process. So first, I'll kind of tell you a little bit about BNA and what we do and who we are. So BNA is a licensed insolvency trustee, formerly known as a bankruptcy trustee, is what they used to say. Our office is family owned and operated, so our trustees here are very small, tight-knit group. It's a small office. It allows for a more personalized service when you come in to see us, and we've been in Calgary since 1997, so we've been here for a long time. We've got a lot of experience. We've helped over 10,000 people find a solution to their debts at this point in time. And you know, we've got Consumer Choice Awards and we've got the Better Business Bureau. So when you come to BNA, you know that you're talking to somebody who knows what they're talking about and can try to help guide you to a solution that you come up with on your own. So I guess we can jump into what can the creditors do? So what is their step? So the creditors, what happens usually and during this period of time of COVID is that we start to prioritize what our expenses are. And right now you might have mortgage deferrals, which are fantastic. You might have some utility deferrals. Even your credit cards might be giving you a break, or your lines of credit, car payments, which can be really helpful when your income is reduced at this point in time. But ultimately those deferrals are going to start to come due. And so at that point in time, we have to kind of start thinking about what things we can pay and what we can't pay. And I always talk about priorities when I talk to people about budgeting. Basic priorities are things like food, clothing, medication for the family, shelter. Those are our basic needs for survival as human beings. And then after that, everything turns into a high priority want. For some people, it could be a car payment is their next high priority want. Another high priority want could be a cell phone bill, or it could be, cable bill. Especially when we're stuck in house, it's good to have, some type of form of entertainment. By doing that, we kind of go through our listing of like what's on a priority basis, and sometimes credit cards fall to the bottom, and those are types of unsecured debts. So when we start to miss those payments on our credit cards, or we're making less than minimum payments, the creditors can start to follow through with some of their legal actions, which are methods of collecting on their debts. One way that I tell a lot of people that they don't always realize about is through their bank account. So creditors do have this thing that's called the right to set off. So let's say, for example, I have a credit card with ABC Bank, and then I also have a bank account with ABC Bank. If my paycheck gets deposited into ABC Bank, and I haven't been making my loan payment or my credit card payment, then they could go into my bank account and take out their payment whenever they want. So it's really important for clients to know that that set off exists, and they don't have to provide you with notice. But that's only within their own bank. So ABC Bank credit card can't go into XYZ bank account and take it out that way. So one of the recommendations that we usually have for clients is that if you're struggling to make the payments, it might be beneficial for you to think about changing where your money is deposited, changing financial institutions, just to kind of secure your income at a financial institution where somebody can't access. Overdraft loans are another thing that sometimes when we get into financial difficulties, we rely heavily on. So we allow our accounts to go into overdraft. But at any time, the bank can cancel that overdraft loan as well. So you have to be aware that, negative 500, which you're used to using, and maybe when your paycheck goes in, it fills it back up, and you're like, okay, well, I'll go back into my negative 500. At that point in time, the bank is starting to see signs that you're not paying your debts. They could cancel that overdraft protection as well. So again, it can be a good option for clients to consider securing your income at another financial institution. So then the creditors have to go through a more legal process to try to collect debts from you at that point in time. So when we talk about creditor remedies, the big ones that we typically see are collections. So credit card companies or banks will contact a collections agency to work for them. It might be either internally, so you might have that internal collections. So when I tell people, I say, first, the phone calls that you're going to get after you miss a payment on your credit cards is, hi, this is your friendly neighborhood bank. You missed your payment. And then you'll say, oh, I'll make it up next time. And they'll say, no problem. Just make sure you make it by this date. And then as you start missing another month, the internal collections start to get a little bit more challenging, a little bit more angry, and they're starting to demand payment. At a certain point in time, they're going to say, nope, that's it. If you don't pay us, it's going to go to collections. At that point in time, they'll usually employ another type of collections agency to start collecting that debt from you. So that collections agency will start calling you. And they're not particularly awesome to deal with. So if you want a list of what your rights are in dealing with collections agency, the Alberta service page has a really great handout on dealing with collections agencies, what their rights and responsibilities are, like how many times they can call you per day and what they can say to you. They can never threaten you. They can never say that they can immediately garnish your wages. There's certain things that they can do and they can't do. One of my best pieces of advice for people if you're dealing with a collections agency is if you send them a letter by registered mail, so that's the key, it has to be by registered mail, then at that point in time you can say, I only want you to contact me by mail from now on, and this is my current address. And then they will actually cease calling you on the phone and only send you collections letters. But you have to jump through the hoop of sending them a registered letter. So it's an option. You can try, definitely. And I will sometimes use that with certain clients. Another option that the creditors have is that they could get a judgment against you or issue a judgment against you. So the creditor can take a client to small claims court, at least that's what it's called in Ontario. Here it's called the Court of Queen's Bench, to get a judgment against you. And when they go for a judgment, what they're going to do is they're going to file a statement of claim. So you're going to see something come to you in the mail. And it's not just like one sheet of paper. I've seen clients come into me with that one sheet of paper. And that one sheet of paper is just an issued demand note from the collections agency saying that they're going to take legal action. A statement of claim is actually like at least 20 pages. It's going to be very formal looking. It's going to have your personal information, the bank's information, and then it's going to have like a schedule attached to it or some information on the debt. So you'll actually see maybe a couple of your credit card statements in there. It'll show interest accruing. And when you get a judgment or a statement of claim against you, you have a couple of options. You can defend the judgment. So you have 21 days to file a defense. A lot of people think super scary filing a defense. 21 days, you would go down to the courthouse, fill out some paperwork and filing your defense. I believe it costs $45 to file a defense. And then you can just say, yes, this is my debt and this is how much I can pay, or no, this isn't my debt at all. I don't know whose debt it is, but it's not mine. And then you'll, usually meet in front of a registrar and they'll have a conversation, like essentially a hearing to talk about this debt or a mediation. If you don't file a defense or you don't show up for that hearing date, at that point in time, this creditor will get an automatic judgment against you. So an automatic judgment is where they can go after you for whatever they've outlined in that statement of claim. Usually they're looking for to either put a lien on your property, so it could be your house, it could be your car, or they're possibly looking at garnishing your wages at that point in time. I want to say one clean thing about CERB right now. So CERB is not considered income, so you don't have to worry about CERB being garnished directly. Any other type of income from the government as well can't be garnished directly. But again, if you bank with a financial institution who you owe money to and you're not currently paying, once it hits your bank account, they can then go into that bank account and take that money out. So if you are collecting CERB and you're banking with a financial institution who you're not paying your debts to, it's a good idea to move your CERB over somewhere else. You can do that through your MyCRA account. You can change your banking information quite quickly. Okay. So what can you do? There's a long list. A lot of people will come to me and say, I have no other option. I have to file for bankruptcy. And then when we actually go through the list of options that they have available to them, a lot of my clients will say, I didn't realize I had so many options that I could do. And that's a really good thing. Nobody wants to make a decision walking in when they feel like they're up against the wall. So we have informal options, debt management or orderly payment of debts, as well as the services that we provide as a licensed insolvency trustee. And I'm going to go in pretty deep on each one of these so that you can have an idea of the pros and cons of each one of these options. So for informal options, the first one I talk about is being judgment proof. And this kind of goes back to when I was talking about how creditors could issue a judgment against you through a statement of claim. So clients that are judgment proof, they're receiving supplements from the government as their only income. They have very little assets, so they don't, possibly have a house, or if they have a vehicle, it's not worth them more than $5,000. And we refer to them as being judgment proof. Essentially, if those clients get sued and they get a judgment against them to garnish their wages, that creditor can't go to the CRA and now ask the CRA or AISH or Alberta Works or any of those people to send them money first. And that's how a garnishment works. So let's say I owe for a credit card and I'm not paying it. And my credit card company goes and gets a judgment against me to garnish my wages. They can then give something to my employer that says, hey, BNA, you have to give us at least almost up to 30% of Nicole's paycheck, send that to us directly, and then you can give her the other 70%. That's how a garnishment works. But that creditor can't go to Alberta Works or to AISH or to CPP or OAS and say, hey, CRA, send us 30% of this person's AISH and give them the rest. The CRA won't recognize a judgment. So that's why we call these clients judgment proof. So a lot of times when I'm working with my clients that are judgment proof, especially if they're on Alberta Works, they're probably only receiving about $600 per month. It may not be a good, like it may not be advantageous to file for a bankruptcy or consumer proposal that might, or anything else, any one of these other options, it might be just too burdensome on the budget. Then I say, okay, at that point in time, maybe you should just change your phone number, change your bank account. You can ignore the creditors. And unless you start working at an actual job or you're receiving a paycheck, you're essentially judgment proof. So you could ignore this debt at this point in time. It doesn't mean that it goes away. The debt is still there. The creditor could try to pursue other legal actions if possible, but it's a good thing to know, especially if you're on a very limited income, that this could be an option. Another option that I talk to my clients about are consolidation loans. So usually this is through a bank, and it's the function of a consolidation loan is to take all of the debts from other areas that you might have multiple credit cards and combine it into one more lower interest rate loan that you can pay off, where the payments are going to be smaller and the interest is going to be smaller. Usually, especially at this point in time, one, the banks are looking specifically for income. So they're checking for income. They're looking for very recent pay stubs to make sure that you have income, because a lot of people have been laid off due to COVID. And they're also looking for possibly security. So let's say you do have this car sitting over there. They might say, okay, we'll give you this loan, but we're going to secure this loan to that car. Meaning if you don't pay this car loan, we're going to come take your car. And that's the kind of security deposit that they're going to take. So consolidation loans are an option, but I kind of tell everybody that's looking for one, just go into the bank expecting a no, and that way you're not as disappointed if the no comes up, because a lot of the banks are kind of tightening up their belts on lending at this point in time, and it's more about the economy and less about clients. It's just they're a little risk adverse at this point in time. Last option, as far as informal options, is just to do nothing. Bad debts will fall off your credit report within about a 6 to 7 year period of time. But again, just because it fell off your credit report does not mean that it ceases to exist. So sometimes I'll find with clients that they might have a really old debt, and then it gets sold to another collections agency, and all of a sudden it reappears on their credit report. And then maybe 5 years later it falls off again, and then it reappears on their credit report because it got sold to another debt collections agency, and it just kind of goes around in a circle. I actually had one client who had a Sears credit card, and it showed up 30 years after she had not stopped paying the debt. So it's kind of crazy, but it can keep popping up on your credit report. So I say it's kind of like plastering a wall. You can plaster the wall and hope that nothing comes through the wall, but until you deal with what's inside the wall, you can never guarantee that it's not going to rear its ugly head again, okay? So those are our informal options, lots of options there. So debt management plans and orderly payment of debts are kind of like the next step down the list of things that we can do. It's a voluntarily, excuse me, a voluntary program. It's either through a credit counseling agency or an orderly payment of debts agency, and they kind of act as a third party between clients and creditors. We have some really great programs here in Alberta that are able to help with this. So if you're looking for a credit counseling agency, that would be the Credit Counseling Society. And if you're looking for an orderly payment of debts program, that would be through Money Mentors. Both of those programs are nonprofits, and they run across all of Alberta, and even Credit Counseling Society is also across Canada. They have some really great programs and some additional things that go along with it as well. So after this, I can provide you with some additional contact information if you wanted to check them out, but they are very much legitimate programs that can definitely help you get out of debt. So the client will make a monthly payment to the credit counseling agency or the orderly payment of debt program, and the agency will then make monthly payments to their creditors. So it's kind of like they act like a middleman. So they pay, like you pay the credit counseling agency, the credit counseling agency every month goes and then pays all your creditors for you on a monthly basis. You have to pay back 100% of the debt. So if you owe $15,000 in total amongst all these creditors, you're going to have to pay back $15,000. But what they are going to do and where the benefit lies, not only is it just one monthly payment for you, which can be very easy to manage within your budget, a lot easier than multiple payments, is that they can negotiate a lower interest rate. So for the most part, interest rates hover between about 0 to 5%. Most of the major banks will drop their interest rates down to 0. Some banks will do 5%. The occasional bank will stick around 9%. So it depends on the creditor and the arrangement that they have with the credit counseling agency. An orderly payment of debts, it's 5% across the board. So some other features, again, one monthly consolidated payment for the client, making things a lot easier. There's significant interest relief in it. So if you're paying credit cards at 20% or you're paying a high interest loan at 35%, this can be a huge break for you. It's facilitated by a nonprofit organization. You have to pay back all the debt that's owed. Both of these programs also will provide additional support through financial coaching sessions and assistance as well. So that's what I really like about it, is that you get to have these additional ongoing budgeting sessions with these programs so that you can learn how to get better at budgeting your money, keeping an eye on your money, and having that person that you can just kind of bounce your ideas off when it comes to your budget. So that's really beneficial. Also, for anybody who's not struggling with debt, these two programs as well offer some really great workshops on budgeting and money management strategies, as well as they will offer budget coaching, and you don't have to be in debt, and you don't have to be in one of their debt management or orderly payment of debts programs to be able to access those types of programs. So definitely reach out to them for financial support if you need it. Okay. So then we get to a licensed insolvency trustee, and this is the world that I live in for the most part. So a LIT is short for short form, a licensed insolvency trustee. They're highly educated, so there's a lot of training that we have to go through to be LITs. It's federally regulated, so we have a regulator that makes sure that we're doing our jobs properly, that we're licensed properly. It's the only organization that's authorized to administer insolvency proceedings. So there are a lot of companies out there that will tell you that they can do consumer proposals, but they're not LITs. So you need to be very careful of those companies. Usually they'll charge very large upfront fees to start. So always, 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 when you're looking for a licensed insolvency trustee, the first thing you should ask is, are you a licensed insolvency trustee? Because if they can't say that, then you need to contact somebody who is. Just Google search it. There's tons of us all around. We're all federally regulated. We're all licensed. All trustees kind of run in the same pool. Like, we're all, you know, legitimate. So we have to adhere to professional standards of practice through our Canadian Association of Insolvency Restructuring Professionals, and we're subject to oversight by the Office of the Superintendent of Bankruptcy. So we're regulated by the OSB, which is the Office of the Superintendent of Bankruptcy, and the Court of Queen's Bench. Essentially, we're court officers. So we don't work for you, and we don't work for the creditors. We stand in the middle like a referee. And our job is to make sure that the rights of the client, the rights and responsibilities of the client, as well as the rights and responsibilities of the creditors, are both respected and adhered to. So that's the most important thing about a licensed insolvency trustee, is that we can't take sides. We have to just make sure that we follow the regulations and how they're set out for us. So the licensed insolvency trustee kind of has two options to run with. They can do proposals and they can do bankruptcies. And they function very differently. Under proposals, we have specific, we could do a consumer proposal or a division one. There's a little bit of a difference between the two. As well as bankruptcies, we can do a summary or an ordinary administration. But for most people, it's just easy to understand. I can either make a proposal to my creditors or I can file for bankruptcy. And what do those two options look like? So when we do consumer proposals, it's a way for you to pay your unsecured creditors back a percentage of what you owe them over a maximum of 5-year period of time without any interest. So there's no interest charge on it. We're essentially kind of making a deal with your creditors to say, hey, you know what? They owe you $30,000 in credit card debt. Can't pay the whole $30,000. Will you guys take $15,000 and we'll call it a day? Ultimately, there's a lot more work that goes into that consumer proposal, but that kind of gives you the gist of what that deal kind of looks like. your total debts have to be under 250,000. So that's where I was talking a little bit about the difference between a Division 1 and a consumer proposal. When you're looking at your total amount of debt, if it's less than 250, then you're doing a consumer proposal. If it's more than 250, you're doing a Division 1. There's some slight differences between the two proposals that most clients kind of want to have an idea about. So the client has to surrender all of their credit cards when they're in a consumer proposal, so you can't keep one out. I get asked that all the time. Can I just keep one credit card? I needed to book a flight. I needed to, book a hotel room. And I get it. I love Amazon, so like I'm the first one that wants to have a credit card. But ultimately, all creditors have to be treated equally. I kind of say they're like our children. We have to love them all equally. Creditors have to be treated equally. It's not fair for one of them to get left out while the other ones aren't getting paid back all of what's owed to them. So it's a really great opportunity too for clients to just learn to live on cash for a while. Doesn't mean you can't have credit cards during the 5-year period of time. So it's a question I get asked. Do I have to wait until I'm under my consumer proposal to get a credit card? You don't. You can have a you can have a credit card while you're in your consumer proposal. It's a good idea to give it some time to wait, but there's nothing stopping you from doing that, okay? Legally binding agreement with all your creditors. So once we file the proposal, something gets implemented called a stay of proceedings. So a stay of proceedings is like a giant wall that we put up between you and your creditors. And it stops them from doing judgments or collections against you or anything. It just kind of bounces off. So that's what the stay of proceedings is there for. And at that point in time, we have to wait. So along down a little bit further, the creditors have 45 days. So we send in the proposal and say, this is what the client is proposing to settle with you. And then the creditors have 45 days to kind of put their ducks in a row and decide whether they're going to accept this proposal or not. And then at the 45th day, we're going to know whether the proposal is accepted. For the most part, they're accepted. I want to say the majority of times consumer proposals are accepted. Occasionally, the consumer proposal could be rejected by a creditor, but most of the time what they're doing is they're coming back and they're saying, we didn't like the offer that you put forward, but we would accept if you changed it to this. So there's a bit of a negotiation process or a little bit of a wiggle room there with the creditors. As far as it might go up, we can't go down. Once we submit one, it's not going to go down from there, but it could go up from there. And it's possible to continue with the consumer proposal, just maybe at a higher payment. Your credit rating is severely affected by this. So I didn't talk about that in the orderly payment of debts, but it's also affected in debt management and orderly payment of debts as well. So it'll affect your credit rating. Let me just kind of sidebar, talk a little bit about credit ratings for a second. So ultimately, credit ratings are on a scale of 1 to 9. So what your creditors do is your credit report, which is housed through Equifax and TransUnion, is like a report card that all of your creditors make for you. And you don't get a lot of input into it. You just get to review it and make sure it's correct. So each creditor gets to give you a grade, and the grades are on a scale of 1 to 9. So 1 means I'm making all of my payments on time as agreed. 2 means I might have been like 30 days late with a payment. And then 3 is 60 days and so on and so forth. By the time you hit 5, if you're rated 5 on your credit score from a creditor, it means that they're about to send you to collections. So 5, anything less than 1 is not good, but 5 is like you're kind of on the cusp of bad debt. There is no 6. They've left it open. I don't know for what, but there is no 6. And then 7 means that you're paying it back through like a consolidation order or an orderly payment of debts program. You've made an arrangement with the creditors. 8 means that you had this particular item repossessed. So you would see this on mortgages. You might see it on car loans. And then 9 just means bad debt, filed for bankruptcy, gone to collections. Okay? So those debt management plans and those orderly payment of debts, they will drop all of the debts included down to a 7, meaning I'm paying it through some type of consolidation order. When you do a consumer proposal, those debts will actually drop to a 9 because they're like, we're not receiving our payments as agreed until you pay off the proposal at about 5 years, and then you bump up to a 7. The key is that you have to be monitoring your credit report to see if the changes happen within the time limits. So that's something that Your licensed insolvency trustee should be providing you information on how to do so that you can repair your credit. Same with the credit counseling agencies and money mentors. They can provide you with information on how to update your credit report. There's also companies out there that you can hire to kind of help you repair and rebuild your credit. But I tell a lot of people, with a little bit of research and a little bit of patience, because that's what it's going to take, you can repair your credit on your own, and it's not going to cost you anything. So just a little bit of knowledge and a little bit of patience, and it should be able to be repaired when it's supposed to. So the consumer proposal stays on once you get the creditors to agree, and now we're kicked into this proposal and you're just making payments on a monthly basis. It's just going to stay on your credit report until you make your last payment, and then for an additional 3 years. If you miss 3 payments during the term of your proposal, unfortunately, your proposal is annulled. There's nothing the trustee can do about stopping an annulment after 3 missed payments. There is an ability to kind of reactivate your proposal if the reasons are like there was some major crisis that affected those 3 missed payments, but ultimately, the trustee should be notifying you when you're getting to the point of missing 3 payments and warning you that an annulment might happen. So upon completion, any remaining portion of the debt that hasn't been paid, so let's say, again, same example, you owe $30,000 and now you're doing a proposal for $15,000. That 15 that didn't get paid just gets written off by the creditor. You do have to attend 2 mandatory counseling sessions with the licensed insolvency trustee to complete your consumer proposal. So that's it. Make your payments, do the counseling sessions, and then you're done the proposal. Nice thing about the proposal is that you could pay it off sooner. So a lot of people will, you know, times get better. A lot of times, like, most people don't come into my office because they're not really good at managing their money. They come into my office because a life event made it impossible for them to manage their current lifestyle, and the adjustment period just took too long. So in those particular cases, things get better, and then you're able to actually pay more per month onto your proposal and actually get it done faster. So you can get it done faster than 5 years. There's nothing locking you into a 5-year term. Okay, on to Division 1s. So they're very similar to consumer proposals, but your debt has to exceed $250,000. So surprisingly, more and more people are having to do Division 1 proposals. And the reason that I'm seeing most people having to do Division 1 proposals is because they have rental properties. So this would include a mortgage from a rental property as well into that 250. So the minute you have a rental property, even if you're considering keeping the rental property, you're immediately into a Division 1 proposal. So that's something to keep in mind. The repayment term is not capped at 5 years. So that can be really convenient for clients who have a significant amount of debt. So sometimes I might run into a client who has a lot of CRA debt because they were operating their own business. And for us to pay it off in 5 years, the monthly payments would just be something that they couldn't manage. So sometimes we can kick out a Division 1 proposal to a 6 or 7 year period of time to try to make things a little bit more reasonable. Again, got to surrender all those credit cards, and everybody's got to be included in the proposal. It's legally binding. This is one of the changes to this versus the consumer proposal. The creditors have 21 days to vote on the proposal versus the 45 days that they had in the consumer proposal. So there's a shorter window of time in which the creditors have to vote. If you miss 1 payment or fail to remedy that payment within 30 days, so essentially like 2 months, you're deemed bankrupt. So with the consumer proposal, if you're annulled, nothing really happens. You're just annulled, and then you're kind of back into this limbo land with your creditors on your own. Where in a Division 1, if it fails for any reason, like you failed to remedy your missed payment, or your creditors voted down this proposal, or the court said no to your proposal, then at that point in time, you're immediately into a bankruptcy. You don't get to say yes or no. It just happens. It has to be approved by court. And you don't have to complete the financial counseling sessions, although for clients that are in a Division 1 proposal, I recommend it might be worth it to attend the counseling sessions for individuals, for sure. All right, so bankruptcy. So bankruptcy can be a period of time. I kind of say, like, you and your trustee are running a marathon together, and you both have to or want to get to the finish line at the same time. And that's how a bankruptcy happens. It's a period of time in which we look at your financial situation. Where a proposal, we take a snapshot in the front end and base the proposal on that. In a bankruptcy, we actually monitor you during this period of time. So people say, well, how long does it last? It depends on a couple of items. Usually, if it's your first time for bankruptcy, it's going to be 9 or 21 months. Everybody thinks it's 9 to 21 months. It's like 9 or 21, one or the other. And then if it's your second time or more filing for bankruptcy, it's 24 or 36 months, one or the other. And I'll tell you in a bit what would constitute 9 or 21 or 24 or 36. Again, you got to surrender all your credit cards. Can't keep one of them. There's a stay of proceedings, and it stops all collections and garnishments. So the minute you file for bankruptcy, at that point in time, your creditors can't come after you. There is one specific creditor that can continue to garnish that I kind of see on a regular basis, which is maintenance enforcement. So if you're owing for child support or spousal support, that garnishment may not stop. So it depends on maintenance enforcement, and there's nothing that we can do. They have a specific section of the legislation that allows them to continue to collect. And a licensed insolvency trustee will take possession of all of your non-exempt assets. So let's talk a little bit about assets and how they function, because that's really the big two pieces of bankruptcy: assets and income. So let's look at assets. If your realizable assets are more than $15,000, we're going to do something called an ordinary bankruptcy. For you, for a client, that doesn't really mean anything. It's more for us, for the administrator. But the one change for that ordinary bankruptcy that you're going to have to keep in mind is that there will be a notice in the newspaper, and we have to have a mandatory meeting of creditors. A lot of people are really concerned about the notice in the newspaper. This is the only one in which you would have a notice in the newspaper. Most people don't read it. It is good to know that there's always a public record of a bankruptcy or a proposal. It's housed with the Office of the Superintendent of Bankruptcy. So at any time, you could go on to their website, create an account, pay $8, and search as many bankruptcies or proposals as you wanted to. So there's always a public record of it. Lasts forever. So when we look at assets, people own a lot of assets. So we'll take a house. We'll start there. It's $40,000 of equity in your principal residence. So equity means the difference between the value of your home and your mortgage or mortgages if you have multiple mortgages. So this amount is called equity. So if you have more than $40,000 of equity in that house, then that additional over $40,000 is something that the trustee is going to say, hey, wait a second, I'm going to need some of that. Everything over $40,000. If you have less than $40,000 worth of equity in your house, the trustee is going to say, well, I'm not interested in the house. You can take it and continue to pay your payments to your credit, like your mortgage, and keep your house. Some people will file for bankruptcy and say, you know what, I've got this house and it's underwater, the mortgage is too much, I can't continue with it, I can't sell it, I'm in the middle of COVID, it's a condo. So some people will actually consider giving up their mortgages or their houses in bankruptcies. So that is an option to consider as well with your trustee. $5,000 of equity in a vehicle. Again, the difference between the value of the vehicle and the loan. So for the most part, all of us are like here. If you have a car loan, you're like underwater, because that's how cars work. You drive off the lot and they're worth half as much as they were when you bought the vehicle. But if you tend to have a vehicle that's paid off, we're going to take a look at everything over and above that $5,000. So there's a couple of options when you do have equity. The trustee could say, okay, I'm going to take that vehicle, I'll sell it, I'll give you your $5,000 and I'll keep the rest. Or you can say, whoa, I really need that vehicle and I love that vehicle. And the trustee is going to say, okay, so your vehicle's worth $7,000. All right, you get a $5,000 exemption. You have to pay $2,000 into your bankruptcy because that's rightfully what the creditors are entitled to. So that's how assets work. Tools of the trade. This has to be actual tools that you're using to earn an income. So keep that in mind. My husband would say everything in our garage is a tool of the trade. It is not. You've got $4,000 in furniture and appliances, and $4,000 based on like resale value, not replacement value. So a lot of people think, well, it would take a lot more than $4,000 to replace all the furniture in my house. We're looking at resale. $4,000 in clothing and personal effects, again, resale value. Pensions, RRSPs, life insurance policies, and RESPs are typically all exempt. Pensions, every once in a while we have to take a look at the paperwork. For the most part, like RESPs, RSPs, and term life insurance policies are exempt. Personal injury and pain and suffering lawsuit, if you were to receive funds from that, would also be exempt. Some non-exempt items that you need to be aware of, TFSAs are a big one that I see. So if you have a TFSA, that is not, the entire thing is not exempt. The trustee is going to say, oh, okay, you got $5,000 in your TFSA. That's going to have to come into your estate to pay your creditors. If you had a loss of income lawsuit, that would be something that the trustee would want to investigate. Settlements, lotteries, inheritances, windfalls are big ones that we run into. So it's not just like at the outset. So like, oh, I'm filing for bankruptcy and I have $15,000 of an inheritance sitting in a bank account. It's like, if during that 9 to 36 months you receive that inheritance is the trustee's. So I tell people, you get anything in your bankruptcy period of time, we as the trustee have to investigate whether that's something that would come into the estate or not. And the reason being, a lot of people think it's unfair, but if you think about the logic behind it, if you didn't file for bankruptcy and you received that inheritance, likely one of the first things you were going to do with it is pay your debts. A lot of people will use lotteries, inheritances, and windfalls to try to pay down their debts. So that's kind of where the logic is coming from. Income tax refunds as well are going to be assets of the estate. So if you were expecting a big juicy income tax refund for the year that you filed for bankruptcy, it's going to be sent to your trustee. So don't expect your income tax refund either, okay? So that's how assets work. So we kind of like look at, all right, how much are we going to get out of this estate, out of assets? And we look at that general number. For the most part, it's zero, but occasionally we will have people that have over-exempt assets, or we might have some TFSAs, or we might have a windfall that happens during the bankruptcy. So there's that certain amount of money that we're going to get from assets. And then the trustee's job is to monitor for income. So that's piece 2 of the puzzle. And so this superintendent standard, the Office of the Superintendent of Bankruptcy, has essentially issued out every year this superintendent standard number. And it's kind of based on the amount of people that are in a family unit. So they say, for a single family of unit, the income is $2,243. So that's what that little chart says. For a family of 2, $2,793, and so on and so forth. This is not to say that the government feels that a family of 1 can comfortably live on $2,243. They actually base this number on the LICO, or what they call the low income cutoff. They use the LICO score for a variety of other things that they do within the government. So they'll use the LICO to determine who would qualify for Alberta Works. They use the LICO to determine who qualifies for GST credits. So this is the number that they use across the board for multiple calculations, including what we call surplus income. So ultimately how surplus income works is it says, if a single person, on average, so over the 9 to 36 month period of time, is making more than $2,243, then every dollar over, this is a simplification, but every dollar over the $2,243, every dollar above that, half of it, you got to give to the trustee, and you get to keep half. Half to you, half to the trustee, back and forth like that. If the client on average is making less than that $2,243, then there is no surplus income payable. There's nothing. Okay, so every month you're going to be required, depending on the firm that you work that you're working with, every month you're going to be required to report your income during that period of time. They're called monthly income and expenses. So we're going to be monitoring your income to say, okay, month 1 they were under, month 2 they were over, month 3 they were under. We're kind of doing this thing, and we check and see at the 7th month we kind of calculate out, okay, are they over or under? And if you're over, then your bankruptcy is going to go for 21 months. So that's where the length of time goes. So if it's your first time bankruptcy, we monitor you for those 7 months, average you over those 7 months, and decide were you over or under. And if you're over, boom, 21-month bankruptcy. For a second time bankruptcy, it's the same kind of thing, except we monitor you at the month 21. And we say, were you over or under? And if you're over, at month 21 on average, then boom, 36-month bankruptcy. They just add an additional 12 months to your bankruptcy because you're in surplus. So that's how that duration thing works. And then you're required to make those payments. Now keep in mind, it's a moving scale. So a lot of people are like, man, what am I going to pay for surplus in my bankruptcy? And I'm like, I don't know. I can guess. And based on my crystal ball, I'm thinking it's going to be this much, but it all depends on what happens. You might get a second job during your bankruptcy, and then your payment's going to go up. You might lose your job in your bankruptcy, and then your payment's going to go down. So it's really hard for the trustee at the outset to really know, like we can never know what your bankruptcy is going to look like until we get to the end, right? Nobody knows what place they're going to come in a marathon until they get to the end of it. So that's kind of why I call it a marathon. So this is kind of a calculation for you to look at on how we come out with it. So this is for a family of two. When one spouse makes $2,000 and the other spouse makes $3,000. And just because your spouse is reporting their income doesn't mean just because you file for bankruptcy, your spouse doesn't have to file for bankruptcy. It's another question I get a lot. So it could be just you, but the family income in total is $5,000. And they're allowed the first $27.93 to keep, and then every dollar over and above that, which is $22.07, half of it has to be paid into surplus, which is $1103.50. Now, because only one spouse filed for bankruptcy, they only have to pay their portion of that surplus. So that's why that bottom line there talks about 40%. It's because spouse number one was 40% of the family income, so they only have to pay 40% of the surplus. Again, it can be a bit tricky, but once your trustee runs through it with you, and we do it here in our office and our initials and through by hand calculations and kind of show you how we came up with our numbers, it's a good way to kind of understand where that surplus. So now, before I get back into that, essentially we have assets and we have surplus income, and those two things together combined are essentially the money in the pot, your estate, that your creditors get to share. And that's what the trustee's job is, to take that pot or that cake and break it up into pieces and give the creditors their piece of the pie. All right, so duties. There's some specific duties that you have to do. If you remember when I talked about proposals, I said you just got to make your payments, you got to attend 2 counseling sessions. In a bankruptcy, there's a little bit more. So you always have to submit those monthly income and expense statements. You have to make your monthly payments to your estate, which is probably, could be surplus or it could be just voluntary payments. So somebody's got to pay the trustee to do the job. So if you don't have any assets, you don't have any surplus income, somebody has to pay the trustee to do the bankruptcy. So a lot of trustees will charge around $200 a month for you to file for bankruptcy. So that's going to be your minimum cost, and those are called voluntary payments. You have to attend those 2 counseling sessions that you would do in a consumer proposal. You still got to do them in a bankruptcy. And then you have to help the trustee to attend to your taxes. So the trustee is required to file your taxes for the year that you file. So if you filed today, your trustee would have to do your 2020 taxes. And they would actually do it at it would be this broken like tax season, but you would have your taxes filed. It's called the pre, from January 1st to today's date. That's the pre. And then your post would be actually today's date to the end of the year. So you would have your taxes filed over 2 years, or over 2 parts of the year. You would not be responsible for taxes due during your pre, but you would be responsible for taxes due during your post, because that's a post bankruptcy debt. Credit ratings. So your credit rating is going to be affected in a bankruptcy. You're an R9 for 6 years after your discharge. So if your discharge is 9 months, it's 6 years plus 9 months. If it's 21 months, it's 6 years plus 21 months. And if it's your second time or more bankrupt, it's going to stay on your credit report for at least 14 years, plus however long it took you to get discharged. So it could be 24 plus 14, or it could be 36 plus 14. So usually around those times, I talk to clients about, if it's your second time bankruptcy, is it better for us to do a proposal? So let's kind of harken back to the proposal. The proposal is where you're making a deal with your creditors. And remember, I said bankruptcy is 2 pieces of the puzzle: assets and surplus income. I come up with a number. And let's say in our analysis, we come up with an estimation that in a bankruptcy, you might have to pay back $12,000 because of your assets, your realizable assets, and your income. $12,000 is going to go back to your creditors. So in a consumer proposal, the job of the licensed insolvency trustee is to make sure we offer the creditors more than what they would receive in a bankruptcy. Because if we don't, the creditors are just going to be like, well, tell them to file for bankruptcy. If I'm not going to get at least $12,000, then why would I bother? So usually your licensed insolvency trustee will talk to you about what is a really good beneficial option to offer to your creditors. So, 15, 17, 18, 20, what does it look like? And that's where the number for that consumer proposal is based. It's not based on the total amount of debt that you owe. A lot of people think, oh, I was told I was only going to have to pay 40% of my debt back. It's like, no, it has nothing to do with how much debt you have. It has to do with how much your creditors would get if you had to file for bankruptcy. And that's where we base our number off of. Okay, so pros and cons. Why would you choose a bankruptcy over a proposal? It really depends. In a proposal, it's really good for clients that have an ability to pay. Possibly if you're sponsoring family abroad. So if you're thinking about sponsorship for a person out of country, proposals can be better because Immigration Canada may or may not allow you to sponsor somebody while you're bankrupt. Really good conversation to have with an immigration lawyer if that's something that you're looking at. Some people just feel morally they want to do a proposal instead. That's fine. Or possibly you have that prior bankruptcy. Like I say, don't want to run your credit report for 14 years. Maybe better to just do a proposal. It stops all creditor legal action, and maybe you have a lot of equity in your assets. So you got a lot of equity in your home, but you're not able to refinance at this current time. Maybe a proposal is a better option. In a bankruptcy, I find bankruptcies can be really beneficial for clients that have a low income, so they're under that standard, and especially if they don't have a lot of assets. So if they have very limited assets, very limited income, bankruptcy, it's kind of like easy peasy, 9 months in and out, just do your things and you're good to go. Stops the creditor legal action. It's a quicker process. It's always quicker and cheaper to actually do a bankruptcy. If you think about it, if a consumer proposal always has to be more than a bankruptcy, your bankruptcy is always going to be your cheapest option. It just tends to be in a shorter period of time, so those monthly payments can be a bit higher. You can rebuild your credit sooner sometimes. And again, if you don't have any assets, that bankruptcy might be a really good option. So the last slide, Jody, is just our contact information. So I'm all up for questions, unless you wanted me to go over anything else.
No, Nicole, this has been so amazing. I actually do have a couple of questions here. The first one is, do you have to go in physically to an LIT?
Yeah, I mean, you don't like physically, meaning because of COVID. So most LITs right now are offering services over the phone. And the Office of the Superintendent of Bankruptcy has provided us with the ability to do assessments and sign-ups via video conferencing and phone conferencing. So right now, I've actually done quite a bit with clients over the phone. And then we do our office, some offices are, some offices aren't, are offering face-to-face. And I have some fantastic face masks that I bought from a local person who made these. I always have to give a shout out to local people that are working on stuff like that. And yeah, so you can go into the office face-to-face, or you can do it over phone and video.
Okay, wonderful. Thank you. The next question we have is, how about line of credits if the client can't pay it off? And I think what they mean is, could the line of credit debts be added into the bankruptcy claim?
Yes, so all unsecured debt. So I will find though that sometimes lines of credit, what the banks are doing is lines of credit sometimes are being attached to homes. In those cases, they'll call them something called like a HELOC, or a home equity line of credit. Mm-hmm. If it's a home equity line of credit, then the problem with that one is that unless you're willing to walk away from your home, then you're going to have to continue to pay that line of credit. If it's just a regular unsecured line of credit, like you don't have anything attached to it, then by all means, we're going to have to include that, because all debts have to be included in bankruptcies or proposals.
Okay, great. Thank you. I'm also just going to put it out there. If you have any other questions, feel free to type. Another one did come up. What kind of fees does BNA charge?
Yeah, trustee fees are a really good question for you to ask all of your trustees. So one of them is ultimately a trustee doesn't charge any upfront fees. You shouldn't have to pay anything to just call a trustee and talk to them on the phone, or walk into the office and talk to them. All the trustees are offering free consultations. And then after that, let's say you you decide to do a consumer proposal or a bankruptcy, the trustee at that point in time, their fees actually come out of the pot of money or that estate that I was talking about. So you don't have to worry about any additional fees that you have to pay the trustee. It's called a tariff that they take out of the proposal, and it's regulated. So especially in consumer proposals, no trustee can take more than any other trustee of their piece of pie. We all have a specific amount of tariffed fees that we can take. Where in a bankruptcy, remember how I said if you have no income and no assets, somebody has to pay the trustee for the job. Most trustees are in and around the $200 a month for 9-month fee. Some are a little bit less, some are a little bit more. And if some are a little bit less or a little bit more, I would ask them, just specifics on why they charge a little bit more or a little bit less. Us, for example, charge a little bit more for our bankruptcies, but we just say it's more of the customer service aspect that you get that we charge just a smidge more than other trustees.
So what I'm hearing, Nicole, and this question isn't there, but I'm just going to say it, because you said it's kind of it's free, right? Consultations are free. This is kind of a process where you should interview who is going to be your LIT, right? Like you should probably not interview them, but you should feel comfortable with them that they're going to have your best interest at heart, and because you're going to have to work with them for a while. Would you agree with that statement?
Oh, 100%. Yeah. I always recommend that, if you have the opportunity, and I know credit counseling and money mentors will do this as well, is they talk to a couple of LIT offices, because you're right. If you're in a bankruptcy, you could be in a bankruptcy for 36 months. And I tell people, I'm like, listen, my job is to try to help you through this process. And I'm obviously going to tell you, because our policy is to be super transparent. So I'm going to tell you about all your options. I'm going to tell you about everything that could happen. I always go worst case scenario, this is what it's going to look like. But because people are struggling through this process, and because we're officers of the court and we have to do what's in the regulations, it can actually get a bit contentious with your trustee at a certain point in time. Like they're like, no, we need this. And you're like, but I don't want to give it. And it can get a little bit argumentative. So if you work with a trustee that you get along with, you've built rapport with, that you can access easily, then go with that one. If you get a really bad feeling about it, just call another trustee and see if you like them better.
Okay, thank you. Another question is, in garnishee proceedings, can you garnish all the banks in Canada if you're not sure what banks the debtor runs his account in?
Yeah, so sometimes the judgment order, and this is what I'm kind of thinking that this question is about. So if the judgment order allows this creditor to garnish all bank accounts, they could attempt to go to all bank accounts. And I also kind of said, I didn't talk about the CRA, but the CRA is a specific type of creditor. So the CRA, if you owe tax money, they have a little bit more reach than any other creditor has. So they don't have to go to court like other creditors have to get a judgment against you. They can kind of just do what they want whenever they want. So the CRA will absolutely go into multiple banks looking for money so that they can collect tax money that's outstanding to them. So when I run into a lot of clients that are unbanked or they don't have a bank account, it's usually because they have a tax debt. Once you file a bankruptcy and consumer proposal, though, it absolutely stays the CRA. So I think for sometimes with my clients that have been unbanked for so long, and they've put it off, and then they finally file for bankruptcy, and we get the CRA off their back, they're like, whew, man, it feels good to have a bank account again.
Oh, that's great. Another question is, can you include business debt in a bankruptcy?
So you can include business debt if you're personally guaranteed this business debt. So business debt is a little bit different. If you have a business, I always talk about a corporation as being a separate entity from you as the person, or like a marionette that you have control over, and this is your corporation. So your corporation has all these business debts that you've told them to go out and get this business debt and go get this business debt. If it's been solely in this business's name, then you may not be directly liable for it. But most banks will not give away money to this corporation without tying the director into it as well. So what will happen is this business debt will have a guarantor in the director. So most of the time, there's no assets in this business. So a lot of the times the clients will just let this business die. And then there's really nothing that the creditors can do unless, of course, there's a tied debt to the person. And if there's a tied debt to the person, then that needs to be included in a bankruptcy or consumer proposal. So I do see that happen quite a bit. So if you're in a situation where you're a person as well as a business owner, a lot of the times when I'm talking to those clients, I talk to them about, I'm actually having a consultation with two different people here, the corporation and the person, and let's talk about who's liable for what.
Perfect, thank you. We have another one here. Can you consolidate all your money owing more than once to make one payment?
Oh, I guess that would be based on the bank's lending policies. Again, I'm finding typically right now with the climate of things financially, they're not even doing first consolidations, let alone second consolidation loans. So it's unlikely that the bank will do a second consolidation, but if you have really good income and you have assets, it's possible that they'll do it, but it's entirely up to the bank's lending policies at this point in time.
Okay, and the second part of that was, does the bank not allow this? So then, like you just said, it depends on the bank policy, right?
Yeah, absolutely. Yeah.
Perfect. So the last question, and in honor of everybody's time here, is do you have to be a lawyer to be a licensed insolvency trustee?
No, actually you don't. And the thing is that most licensed insolvency trustees are not lawyers, but there's a difference. You have licensed insolvency trustees and you also have bankruptcy lawyers. So that can get a bit confusing, but most licensed insolvency trustees have different types of backgrounds. So some of them are accountants. I've seen some that are, artists. Myself, I have an education background. So we all come from different walks of life. And then our Canadian Association of Restructuring Professionals is the one to educate us and kind of put us through our cases and make sure that we have a proper certification. And then the Office of the Superintendent of Bankruptcy is the one that gives us our licenses. I don't have my license up, but Barry and Linnea have their license here. I'm working on mine. It's coming.
Perfect.
And then lawyers, there are bankruptcy lawyers that work specifically on like complicated bankruptcy situations.
Okay, thank you so much. If you have any further questions, they can call the number, right, Nicole?
Absolutely. They can call. All of my information is there. They can reach out to me by phone or by email at any time. I'm always willing to chat or provide answers or information.
Perfect, perfect. Thank you so much for being here. We really appreciate it. The information was so incredible, and I'm so grateful that you were able to share that with our participants. And I also wanted to pump on Thursday this week, we have someone coming in from the Canada Revenue Agency, Bonnie McIntyre. She's going to be talking about the CERB and some income tax frauds and scams that are new. And of course, people are just nasty and they try and come up with ways to scam you. And so she's going to come and talk a lot about them. If you would like to register, the tiny URL is there. It is different than our standard Zoom because the CRA uses a different platform. So if you're interested, copy and paste that link and go ahead and register. It is also on Momentum.org. As well as next week, we have someone coming in, a lawyer actually, coming in to speak to us about rental evictions and what can happen during this COVID-19 time. So just one more time, I want to say thank you so much, Nicole. I hope everybody has a wonderful rest of the day. Take care. Goodbye.